Another critic of the mining tax, Sydney Mining Club chairman Julian Malnick, was headed back to Australia to give an incendiary speech today, but was thwarted by a mechanical failure in his plane, which returned him to Hong Kong. Joining me a short time ago to discuss why so much of the mining sector is still up in arms, and also the challenges for infrastructure in Australia, is Paul Espie, chairman of Pacific Road Capital Management and the Australian Infrastructure Fund. Paul Espie, welcome to LateLine Business.
Thank you, Ticky.
Well, I've got the speech of the chairman of the Sydney Mining Club that he was to deliver today, and he says on the tax, he says if the three big miners had gone back to their mining membership, there's a strong chance that we'd have unified against it and sent Gillard to an election with the ad still running and the burning tire of Kevin Rudd's mining tax still around her neck. Now, what's behind this fury?
I think there's a perception that there was a political divide and rule exercise played out here, and that the three very big producers and the three companies that speak for such a large portion of our export, iron ore and coal, were in a category of their own, and that there are thousands, literally thousands of other mining companies who don't know where they stand in respect of this proposed tax.
Well, you know the small and mid-cap miners very, very well. What are their concerns?
Well, first of all, can I make a point very clearly? This tax has not been put to bed. There's a widespread perception until people like the Sydney Mining Club and the Association of Miners and Explorers in Western Australia and others, including the Institute of Mining and Metallurgy, have started to mobilise around this issue. There's an article today quoting Wood Mackenzie, a well-respected expert in the coal industry, pointing out that $7.5 billion in tax revenue over the next 5 years, if coal prices stay where they are, will be reaped by this tax. But at the same time, $12 billion in value will be taken from the industry. The net present value of those businesses will be down by $12 billion. That's before the flow-on effects through contractors, drillers, and investors, and banks for that matter. It's not surprising that people are a bit upset about the uncertainties of this proposed tax. I've been in the United States, where many of our investors are, and they're astonished about the goings-on in this country, with a massive whack on mining revenues that was proposed in the RSPT, then converted into an MRRT, and then incidentally we got rid of a Prime Minister. This comes as pretty astonishing stuff to the international investment community, where stability counts for so much and where our sovereign risk has been highlighted in a way that most of us would prefer it hadn't happened. Capital is fluid. Capital goes to where it can see an appropriate return for a certain type of risk. If the government puts an extra layer of risk over the top, the capital doesn't flow, and there are cascading effects. The reason why so many of these smaller and mid-sized participants in the mining industry are angry and concerned about all this is that that's where the money comes from to fund the exploration activities of the little guys. That's where the mines of the next generation will come from. Today's mines won't be operating forever. They will become exhausted. It's happening all the time.
I gather in some mining circles there's also a concern that this tax could indeed, this minerals resource rent tax could actually go up, that somehow the goalposts could be changed if there was a deal with the Greens or a possible budget shortfall. Do you think the government would really do that?
I think it's entirely possible. The whole point about the incomplete tax formula as it's presently presented is that it's discriminatory against coal and iron ore and against companies that generate more than 50 million in earnings in a year. They're the ones that are going to cop the tax. But who's to say that that's the end of the story when the detail emerges?
All right, well, let me move to your other area of expertise, which is infrastructure. We hear so much about the challenges of infrastructure, and it's now all wrapped up in this election debate about population. The Australian Constructors Association, Wal King, mentioned today Shanghai as a shining example. From a standing start at 95, it's now got a metro of 400 kilometres of track and 170 stations. Why are we not getting the process right?
I think the comparison with Asia is all too true. We don't take a long-term view about our major infrastructure, and what's more, we can't get the politics right between the federal government, where much of the funding and potentially the investment framework comes from, and the states, where the planning is done or is not done, and the two don't speak the same language, let alone get together with the private sector on a sensible allocation of risk and return to draw private sector capital into the process.
You chair the Australian Infrastructure Fund. How can we attract more super into infrastructure?
This is a very interesting question, and it is the whole issue, isn't it? That the current federal government established and had its most recent shot at setting up Infrastructure Australia. The global financial crisis came along, and of the 150 billion or so that I understand is roughly the total of infrastructure commitments made subsequently, a very, very small proportion went through the screening of the Infrastructure Australia process. That process was very sound, I think, and it did a good job of prioritising, but the behaviour of governments is not consistent with it. I'm familiar with a particular project that's on the table in Sydney right now, where the private sector has volunteered to fund the extension of an infrastructure project, and it's a rational project, it's a rational financial proposal. But the gap between what the bureaucrats are telling the sponsors in that case and what the capital markets would require to put the money in is very considerable. And unless something happens there, it won't occur. So the question is, what does it take to create the incentive for super monies to come into these nation-building projects? Very complex question. The infrastructure bond, I think, served a useful purpose. There has to be a different structure, and obviously the role of the tax system and the devices potentially coming out of that to induce superannuation money, which is fundamentally it's a natural contributor to nation building.
But that's the sort of thing that you'd be looking for both sides of politics to be suggesting now. If they keep going on about where's the infrastructure, we need some of these sorts of incentives.
Yes, I'm not familiar with a very practical proposal to solve that problem just now.
So it's over to the policymakers. Paul Espie, thank you very much for talking to Late Line Business.
Thank you.